Hello, I'm Elon Musk, and I'm going to tell you something that sounds completely and utterly impossible. Hello, I'm Elon Musk, and I'm going to tell you something that sounds completely and utterly impossible. It's a claim that will make 99% of you click away in disgust, convinced it's clickbait, a scam, or a fantasy. But for that 1% who are willing to suspend their disbelief, to question everything they've ever been taught about money, this video will change your life. This isn't just another personal finance video. This is the blueprint. I'm talking about a specific, repeatable framework for how someone, starting with just $20,000, could, in theory, go from that initial capital to a $1 billion valuation in just 4 years. Let's be clear. $1 billion, $1,000 million, in 48 months. Is this a promise? No. Because the journey from $20,000 to $1 billion isn't a simple-to-follow recipe. It's a high-stakes, high-leverage game of chess that requires a specific mindset, a unique set of skills, and an understanding of financial principles that go far beyond budgeting or saving for retirement. This video isn't for the person who wants to slowly climb the ladder. This is for the person who wants to build a rocket ship. Think about it. The world's fastest wealth creation isn't done by saving a few $100 a month. It's done through leverage, high-impact decisions, and understanding a few core principles that the vast majority of people, including many financial advisors, simply don't teach. The strategies I'm about to reveal are not about luck. They are about a system. A system I've spent years reverse engineering from the most successful wealth builders in history. So, if you're ready to stop thinking in terms of small gains and start thinking in terms of exponential growth, then strap in. This is Get Rich Academy, and we're about to dive into the most controversial, most powerful personal finance strategy you will ever see. When I first started on my own financial journey, I was exactly where many of you are right now. I was told to work hard, save 10% of my paycheck, invest in a diversified portfolio of mutual funds, and hope that in 40 years, I'd have enough money to retire comfortably. It's the sensible advice. The responsible advice. And it's the advice that guarantees you will never, ever be a billionaire. It's a game of inches, and the goal we're talking about is 100 miles away. The first major revelation I had was that the rules for becoming rich are completely different from the rules for becoming billionaire rich. The rules for the first are about consistency and discipline. The rules for the second are about strategy and audacity. You see, the traditional path is designed to mitigate risk, but by doing so, it also caps your potential. It's a path for people who want to avoid loss. The path to $1 billion is for people who understand that calculated risk is the only way to achieve outsized rewards. The world's most successful entrepreneurs and investors didn't get there by accident. They didn't win the lottery. They understood a fundamental truth: money is a tool, not a trophy. A dollar isn't something to be cherished and held onto for dear life. A dollar is a soldier to be deployed. It has a mission: to create more soldiers. And your job is to be the general, commanding your army of dollars to conquer new territory. This is a complete reversal of the ingrained scarcity mindset that society teaches us. We are conditioned to think about money in terms of what it costs to have something, rather than what it earns to have something. We're taught to view debt as a moral failing, rather than a powerful financial instrument. We're taught to seek security, rather than to seize opportunity. I'm not here to sell you a fantasy. I'm here to lay out a framework, a mental model that has been used by the world's most successful wealth builders for generations. It's a framework that acknowledges the impossibility of the task and provides a logical, step-by-step path to achieving it. It's about building a series of escalating advantages, a financial flywheel that starts with a tiny push and ends with an unstoppable momentum. Your $20,000 isn't a small amount of money. It is a seed with the potential to grow into a financial forest. But you have to plant it in the right soil. That soil isn't a low-yield savings account or a stock market index fund. That soil is a high-leverage asset. It's a business, a piece of real estate, or a technology with exponential growth potential. This is about understanding that time is the most valuable asset you have. You can't waste it on low-impact activities. Every financial decision you make from this point forward must be weighed against its potential for exponential return. Will this decision help me grow my capital at 7% a year, or will it give me the chance to double it in 12 months? The answer to that question is the difference between a comfortable retirement and generational wealth. This video is an invitation to think bigger. to act bolder, to question everything you've ever been taught about money. It's an invitation to join the 1% who are playing a completely different game. The stakes are high, the risks are real, but the rewards are literally beyond your wildest dreams. So if you're still here, if you haven't clicked away, it's because you know deep down that there must be a better way. You feel that a life of slow, grinding financial progress is not the one you were meant to live. You are the kind of person who is ready to build a rocket ship. And Get Rich Academy is here to give you the fuel. Let's get started. Okay, let's get into the first, most fundamental principle that separates millionaires from billionaires. The vast majority of people are taught the traditional path. This path is all about earning money, saving a small portion of it, and investing it in low-risk, low-return assets over 40 years. It's a good, solid path to financial security, maybe even a comfortable retirement. But it will never get you to $1 billion. It's a linear growth model. The exponential path is different. It's not about saving, it's about leveraging. Think of it like this. A regular person gets a shovel to dig a hole. A person on the exponential path gets a tractor. The tractor is your capital. $20,000 isn't just $20,000, it's $20,000 of leverage. It's the key to a much larger machine. The biggest mistake people make is thinking of money as something to be preserved, not as a tool to be multiplied. They see a $20,000 investment and think, what if I lose it? The person on the exponential path sees the same $20,000 and thinks, how can I use this to control $200,000 of assets, and then use that to control $2 million? It's a game of scale. This is the mindset shift you have to make right now. You are no longer a saver, you are a leverager. Your initial $20,000 isn't a nest egg, it's a seed. And the first step is to plant that seed in the right soil. So, what is the right soil? It's not the stock market, at least not at first. The stock market is a game of slow, steady growth. We don't have time for that. We need a market that is not yet saturated, where we can get outsized returns by being an early mover. The first step is what I call the high leverage acquisition. To truly understand this, we need to go back to first principles. Forget everything you've heard about compound interest being the eighth wonder of the world. Compound interest is for the linear path. For people playing the long, slow game. It's beautiful and powerful, but it is not built for speed. It's like trying to get to Mars by running. You'll make progress, but you'll never get there in your lifetime. To get to Mars, you need a rocket. And in the world of finance, that rocket is leverage. Leverage is the fundamental principle that the ultra-rich use to multiply their money. It's not a secret, but it's a concept that is often intentionally obscured or presented as a dangerous, high-risk activity for the masses. The truth is, it's just a tool. And like any tool, it can be used for immense good or immense destruction. The question isn't whether to use it, but how to master it. Think about it like this. If I give you a $10 bill and ask you to turn it into $11, that's a 10% return. It's a nice return, but it doesn't change your life. Now, what if I told you that you could use that $10 bill to control a $1,000 asset? Now, if that asset goes up by just 10%, just $100, you've just turned your initial $10 into $110. That's a 1,000% return on your initial capital. That's the power of leverage. It's not about the percentage gain on the asset itself, it's about the percentage gain on your initial capital. That's the mindset of a true wealth creator. The traditional path says, here's $1. Go make another $1. The exponential path says, here's $1. Go get a loan for 9 more, and now you have $10 to play with. The first path is about addition, the second is about multiplication. This isn't about being reckless. It's about being strategic. The key is to use leverage on assets that are inherently undervalued and have a high potential for appreciation. You can't just go get a loan for anything and expect it to work. You have to find the right vehicle. A vehicle that is not just going to appreciate in value over time, but one where you can actively force the appreciation. That's a crucial distinction. The stock market is largely passive. You buy a stock, and you hope the company grows and the price goes up. You have no control over it. Real estate, however, is an active game. When you buy a dilapidated house, you're not just hoping it goes up in value. You're actively creating that value with renovations, with a fresh coat of paint, with a new kitchen. You are the architect of your own return. This is why we start with real estate. It's a tangible asset. It's something you can touch, something you can control. The risk is not as abstract as a company's stock price. The risk is in your ability to execute a plan. And a person who can execute is a person who can get rich. This is the first and most important lesson you will ever learn. You are in control. Your success is not dependent on the whims of a market you can't influence. It's dependent on your ability to find a deal, to add value, and to get out on top. This is the principle that separates the hobbyist from the professional. The person who buys a single rental property and holds it for 30 years is a hobbyist. The person who buys a distressed property, forces the appreciation, and refinances to pull out all their cash is a professional. They are playing a different game. They're not waiting for time to do the work. They are making time work for them. So, when I say we're going from $20,000 to $1 billion, I am not talking about a straight line. I am talking about a series of increasingly powerful leaps, each one enabled by the last. The first leap is using your small initial capital as leverage to acquire a tangible, undervalued asset. The second leap is using the equity you created in that asset as leverage to acquire even more. The third leap is using the capital from those assets to leverage a scalable, digital business. And so on. Each step builds on the principles learned in the previous one. It's like learning to walk, then run, then fly. You have to master the basics first. And the most basic, most powerful principle of all, is that your money is a tool. It is an army, and it is waiting for your command. So, with that in mind, let's talk about the first move in this grand chess game, the high leverage acquisition. Year 1 is all about the high leverage acquisition. The goal here is to take that initial $20,000 and turn it into $200,000 in equity within 12 months. This sounds crazy, but it's not. It's done every single day. The secret is real estate, but not in the way you think. Forget buying a house to live in. We're talking about a very specific type of real estate, undervalued, distressed properties. You find a property for, let's say, $150,000 that needs about $50,000 in renovations. The after-repair value, or ARV, is $250,000. That's a $50,000 spread right there. But here's the leverage play. You don't buy this with cash. You use your $20,000 as a down payment. With a good FHA loan or a private lender, you can get the other $130,000. Now you own a $150,000 asset with just $20,000 down. And here's where the real magic happens. You get a rehab loan for the $50,000. You spend the next 6 months executing the rehab plan. You add a bedroom, upgrade the kitchen, fix the landscaping. 6 months later, the house is no longer worth $150,000. It's appraised at $250,000. You've just created $100,000 in equity out of thin air. But we're not stopping there. The final step is to cash out refinance. You go to a bank, and they give you a new loan for 70% of the new appraised value, which is $175,000. You pay off the original loans, and you walk away with a house you own and a pile of cash. You now have a profitable asset and significant capital to reinvest. This is the essence of a high leverage acquisition. You've taken your $20,000 and turned it into an asset worth $250,000, with a significant amount of cash left over. You have not just grown your money, you have multiplied it. This is your first major step. You now have the capital to move to the next level. Let's break this down further, because every single step here is critical. This isn't just a hypothetical scenario. This is a proven blueprint. The vast majority of people get stuck at this first stage, not because they lack the capital, but because they lack the vision. They see a beaten-up house as a problem. A true wealth builder sees it as a puzzle. Your first mission is to become a master of finding these deals. You need to train your eyes to see not what a property is, but what it could be. You're not looking at a house with peeling paint and a broken window. You're looking at a value creation machine. You need to be the person who finds the hidden gem that no one else sees. This means going beyond the standard Zillow search. It means looking for listings that have been on the market for a long time, looking for pre-foreclosure notices, and even driving around neighborhoods to find properties with overgrown lawns and a general look of neglect. These are the distress signals you're hunting for. Once you've found the target, the next critical step is to accurately calculate the ARV, after repair value. This is a science, not a guess. You need to look at comparable sales in the neighborhood for houses that are in perfect condition, houses that have been fully renovated. This will tell you what your finished product is worth. The difference between what you pay for the house, plus the cost of renovations, and the ARV is your potential profit. You need a significant spread there, a minimum of 25%, to account for unexpected costs and to ensure your high leverage strategy works. Now comes the financing, the part that separates the ambitious from the successful. You don't use a conventional bank loan for this. Traditional banks are too slow and too risk-averse. For this type of transaction, you go to a private money lender or a hard money lender. These are investors who specialize in short-term, high-interest loans for real estate projects just like this. Yes, the interest rates are higher, but the speed and flexibility they offer are worth it. Remember, we're not playing the long game here, we're playing the quick turnaround game. They will lend you the money to buy the property and, in many cases, they will also lend you the money for the renovations. Your $20,000 is your skin in the game. It proves you're serious. It's a small amount of money that acts as a magnet for a huge amount of other people's money. The true power isn't in the money itself, but in your ability to control assets far greater than your personal capital. The renovation phase is where you must be ruthless with efficiency. You have a budget, and you have a timeline. Every day you are working on the house, you are losing money on interest. You need a team of reliable contractors who can get the job done quickly and to a high standard. This isn't a weekend hobby. This is a full-time, obsessive project. Your goal is to transform that house from a liability into a highly desirable asset in the shortest time possible. And then comes the final act, the cash-out refinance. This is the key to repeating the process. Once the house is renovated and appraised at its new, higher value, you go to a conventional bank. Now, the bank sees a beautiful, move-in ready property with a high valuation. They are happy to give you a long-term loan at a low interest rate for, say, 70% of the new value. You take that money, pay off the original hard money loan, and you are left with a significant pile of cash. The house itself now generates rental income, which covers the new mortgage, and you have all your original capital back, plus a substantial profit, to go out and do it all over again. This is the power of the high leverage acquisition. You started with $20,000, and in less than a year, you have an asset worth over $250,000, with a passive income stream, and a new pile of capital that is larger than what you started with. You've gone from a simple saver to a sophisticated financier. You haven't just earned money, you've created it out of thin air by adding value to a tangible asset. This is your first taste of what it means to be truly wealthy. And trust me, once you've done this once, you'll be obsessed with doing it again. This is where your financial journey begins. Alright, you've completed your first high leverage acquisition. Congratulations! You've just jumped a massive hurdle that most people never attempt. You now have significant capital and a proven model. The goal for year 2 is simple: repeat and scale. We're going to take the cash you pulled out from the refinance and a portion of your new income and do the same thing again. This time, you'll be more efficient, you'll have a team, and you'll do it faster. The goal is to acquire and flip not 1, but 3 to 5 properties in this year. You are now in the business of real estate. Your $20,000 has become a cash flow machine. The properties you hold generate rental income, and the ones you flip create large, one-time infusions of capital. You are building a portfolio, and with each successful flip, you're not just making money, you're making a reputation. You're no longer just a guy who owns a house. You are now a real estate entrepreneur. The banks see you as a serious investor, which means you have access to better financing, better deals, and more leverage. Your capital is growing exponentially. By the end of year 2, your net worth, the total value of your assets minus your debts, could easily be in the high 6 figures. You've gone from a $20,000 starting point to a true, bona fide millionaire. This phase is all about turning a single success into a repeatable process. You're building the foundation for the massive growth that's about to come. Let's dissect this. Year 1 was about proving the model, about proving to yourself that it could be done. It was the messy, difficult, and high-risk first flight of a prototype rocket. You faced unexpected issues, learned from them, and ultimately, you made it to orbit. Now, in year 2, we are in the production phase. The prototype has been validated. Now, we build the fleet. The most crucial difference between year 1 and year 2 is the transition from a solo operator to a team builder. You cannot scale on your own. You will run out of time, energy, and mental bandwidth. Your mission now is not to swing a hammer, but to find the best person to swing the hammer. You need to identify a reliable, efficient contractor, an expert real estate agent who understands your specific strategy, and perhaps even a dedicated project manager to oversee the daily operations. Your role shifts from the person doing the work to the person orchestrating the work. This is a fundamental shift in your leverage. In year 1, you leveraged capital. In year 2, you leverage people, systems, and time. You are now building a system that can operate without your constant, physical presence. Your knowledge from that first deal, the unexpected costs, the most effective marketing channels for distressed properties, the best way to manage a renovation schedule, is now your most valuable asset. It's your intellectual property, and you are going to use it to build a scalable machine. Think of it like this: your first deal took you 6 to 8 months. You were learning on the fly. In year 2, you are no longer learning, you are executing. You have a templated process. You know exactly what a good deal looks like, what the repair costs should be, and what the timeline is. This increased efficiency allows you to do in 3 months what previously took you 6. You can now cycle through multiple properties in the same amount of time, generating multiple infusions of capital. And this is where the exponential growth truly begins to compound. With each successful flip, your capital base grows larger. With more capital, you can afford to take on bigger projects. Instead of a $150,000 house, you can now look at a $500,000 commercial property that has even greater potential for forced appreciation. You're playing the same game, but on a bigger field, with bigger pieces. Furthermore, your reputation is now your credit score. When you walk into a private lender's office and say, "I just successfully flipped 5 properties in the last year, here are the numbers," you are no longer a risky unknown. You are a known entity. A profitable, proven, and reliable operator. This reputation gives you access to better interest rates, higher loan-to-value ratios, and more favorable terms. The very act of succeeding has made it easier to succeed even more. Let's do some conservative math on this. Let's say you successfully execute 3 flips in year 2. Each one brings in a net profit of around $50,000 after all costs and loan payoffs. That's $150,000 in pure profit. Now add that to the initial capital you had from the first deal. Your capital base is now a multiple of what it was a year ago. You're no longer just talking about $20,000, you're talking about a significant pile of cash. And the properties you've held onto are generating passive income and appreciating in value. Your total net worth, the sum of your cash, equity in properties, and other assets, is soaring. This is the phase of consolidation. It's about solidifying your gains and building a robust system. It's not as flashy as the initial billion-dollar claim, but it is 1,000 times more important. You cannot build a skyscraper on a weak foundation. Year 2 is where you pour the concrete, lay the rebar, and ensure the entire structure is sound. You're proving to yourself and to the financial world that your success was not a fluke, it was the inevitable result of a powerful, repeatable system. This is the moment you transition from an individual with a great idea to a true, functioning enterprise. You are a business, a brand, and a machine for creating wealth. You have mastered the game of linear growth and are now ready to make the leap to something truly exponential. This is where we lay the foundation for the billion-dollar push. Okay, here's the part where we go from millionaire to something far greater. The key to going from millions to billions isn't just about doing more of the same. It's about a strategic pivot. You've spent 2 years building a cash-generating, high-leverage machine in real estate. That machine is now your new foundation. But real estate is a slow, physical asset. The path to $1 billion is in technology, in scalable, digital assets. In year 3, you are going to take a significant portion of the capital you've generated, your millions, and you're going to pivot into a new venture. This isn't a blind jump. It's a calculated move into an industry with exponential potential. We're talking about software, AI, or a digital platform that solves a massive problem. You're no longer the grunt doing the work. You're the venture capitalist. You have the capital, the business acumen, and the credibility to become an angel investor or a co-founder in a high-growth tech startup. You'll partner with a brilliant tech-savvy founder who has the idea but lacks the capital and business knowledge. Your role is to inject the capital and the strategic guidance. You will own a significant stake, say, 30%, of a company that has the potential to grow from $0 to $100 million in valuation in 2 years. Think about it. This is how the real wealth is created. The real estate game got you to the table. The tech game is where you win the championship. This is the moment when you apply the leverage you learned in real estate to a far more scalable asset class. Think of the first 2 years as the perfect training ground. You learned the fundamental laws of leverage, the discipline of execution, and the art of value creation. You became a master of turning a small amount of capital into a tangible, appreciating asset. But let's be honest with ourselves. There's a ceiling to how fast you can scale a physical business. Every new property requires a new search, a new loan, a new renovation crew. There's friction, there are delays, and the growth is, ultimately, linear. It's a fantastic way to become a millionaire. It is not a way to become a billionaire. The leap to $1 billion valuation requires a different kind of asset. An asset that can scale infinitely without physical limitations. An asset where the marginal cost of serving one more customer is near zero. We're talking about software. We're talking about platforms. We're talking about technology that can be replicated and distributed with the click of a button. Your job in year 3 is to take the millions of dollars you've consolidated and deploy them as strategic capital. You're no longer the builder. You're the engine room. You are looking for a brilliant founder who has the idea, the technical expertise, and the passion, but who is stuck. They are the genius inventor. You are the business strategist and the financier. This is a partnership forged in necessity, a symbiotic relationship where your capital and expertise are the fuel for their innovation. So, what does this look like in practice? You don't just put an ad out looking for a startup. You leverage your network. You find a co-founder with a compelling vision. Let's say this person has developed an AI-powered platform that simplifies the legal process for small businesses. They have a prototype, a small user base, and they've proven the core technology works. But they need capital to build out the team, to market the product, and to scale. They are at the classic chasm of the startup valley of death. This is your moment. You come in not just with a check, but with the business acumen you've honed over 2 years. You understand P&L statements, you know how to build a team, and you have a network of legal and financial professionals you can bring to the table. You are not just an investor, you are a force multiplier. You invest, say, $500,000 or even $1 million of your capital for a significant stake in the company. Let's say 30%. This sounds risky, but remember, this is a portion of your much larger net worth, which is still largely backed by your physical real estate portfolio. This is a calculated risk. The key is that your leverage in this phase is no longer just your cash. It's your credibility, your reputation, and your proven track record of successful execution. A bank won't lend a founder $1 million to build a platform. They don't understand it, but they'll lend you $1 million to buy another property. And because of that, you have access to capital that a tech founder does not. This is a massive, unfair advantage. This pivot is the moment you move from being a player in the game to a designer of the game. You are no longer just building assets, you are building companies, and more importantly, you are building a team of people to run those companies. The risk profile changes. You are no longer worried about a leaky roof. You are worried about market fit, user acquisition, and technological breakthroughs. The stakes are higher, but the potential for returns is limitless. Think about the math. A small investment of your capital now has the potential to become a $100 million valuation in a ridiculously short time. That's a 100x return, not a 20% return. The real estate game was a fantastic way to build your war chest. It was the crucial first stage of the rocket, getting you off the ground and through the atmosphere. This strategic pivot into technology is the second stage, where you ignite the main engines and accelerate into orbit, setting your sights on a $1 billion valuation. This is the key to unlocking true, life-altering, generational wealth. This is the final year of the 4-year plan. It's the year where the $1 billion dream becomes a real, tangible target. In year 4, the tech company you invested in has gone from an idea to a fully functioning, high-growth entity. The product is launched, user acquisition is skyrocketing, and the business is gaining momentum. You've successfully helped them navigate the early stages, and now they're ready for a Series A or Series B funding round. This is where the venture capitalists come in. They see the potential, they see the team, and they see your leadership. They want a piece of the pie. At this point, you're not just a co-founder, you're the experienced investor who got the ball rolling. Your 30% stake in the company, which might have been valued at just a few $1 million at the start of the year, is now being valued at $50 million, $100 million, or even more. The exponential growth of a tech startup can be breathtaking. And here's the final piece of the puzzle. You continue to apply the principles of leverage. You can either sell a portion of your stake in the company to raise even more capital for new ventures, or you can hold on to it, knowing that with each new funding round, the valuation of the company, and your piece of it, is growing. Your millions are now multiplying into hundreds of millions. By the end of year 4, the company you helped build is no longer a small startup, it's a unicorn. And your stake is no longer a small investment, it's a path to $1 billion. This is the ultimate test of the system. Year 1 was about proving the concept. Year 2 was about building the machine. Year 3 was about a strategic pivot to a new, more scalable asset class. Year 4 is about hyperscaling. This is where the exponential curve goes from a gentle slope to a vertical line, where the returns you've earned are so large they defy common sense. The venture capitalists aren't just giving money to a random startup. They are giving money to a company that has proven, quantifiable metrics. They've seen the hockey stick growth curve. They've seen the user acquisition numbers, the revenue per user, the retention rates. They see a team that is not only brilliant but has the strategic guidance and capital to execute on a massive scale. And a significant part of that equation is you. Remember, you brought more than just cash to the table. You brought the experience of a successful entrepreneur. You brought the ability to manage a team, to create a repeatable process, to understand business fundamentals far better than a young founder who is obsessed with code. Your capital was the kindling, but your strategic guidance was the oxygen. The VCs are investing in the entire package, and your stake in that package is incredibly valuable. Let's look at the mechanics of this. A Series A funding round is typically for companies that have demonstrated product-market fit and are ready to scale. A Series B is for companies that have proven their business model and are ready to expand and grow their market share. Each round brings in new capital, but it also validates the company's valuation. When a respected venture capital firm invests $20 million in your company at a $100 million valuation, they are essentially telling the entire market that this company is legitimately worth $100 million. And your 30% stake is now worth $30 million on paper. But it doesn't stop there. The capital from the Series A round is used to accelerate growth even further. The company hires top talent, expands its marketing efforts, and enters new markets. The growth curve steepens. In less than a year, the company might be ready for a Series B funding round. Now, a new venture capitalist comes in and invests $50 million at a $300 million valuation. Your original 30% stake is now worth $90 million. You haven't had to do another real estate deal. You haven't had to spend countless hours on renovation. You've simply held your stake in a hyper-growth asset and watched as its value compounds at an insane rate. And this is where the genius of the system truly reveals itself. You have options. You can sell a portion of your stake in a secondary offering to liquefy some of your assets, giving you hundreds of millions in cash to deploy in new ventures, or to simply love on. Or, you can hold on to it, knowing that the company is on a trajectory to become a unicorn, a private company valued at over $1 billion. The journey from $20,000 to $1 billion is not a linear climb. It's a series of escalating leaps, each one building on the leverage gained in the last. You started by leveraging a small amount of cash to control a physical asset. Then, you leveraged the success of that physical asset to build a system and a reputation. Then, you leveraged that capital and reputation to gain a significant stake in a digital asset with unlimited scalability. And now, in year 4, you're leveraging the trust and capital of the world's most powerful investors to validate your asset at a valuation that is simply astronomical. Your role has evolved from a small-time investor to a high-stakes financier, from a tactical operator to a strategic mastermind. You have gone from trying to earn money to creating value on a scale that few people ever comprehend. You haven't just gotten rich. You've built a system that generates wealth as a byproduct of your strategic decisions. This is the moment you've been working for, and it's just the beginning. Now, I can hear you. You're saying, that's all great, but what if it fails? What if the real estate market crashes? What if the tech company goes bust? And you're right, this isn't a guarantee. But what you're missing is the hidden safety net. The entire plan is built on a series of calculated risks, not blind leaps of faith. The real estate phase is your safety net. Real estate is a tangible asset. Even if the market goes down, you still own the property. You have cash flow from rent and you can wait out the downturn. The skills you learned, finding deals, managing renovations, working with contractors, are forever. You are building a skill stack that is transferable and valuable no matter what. The pivot to tech is also calculated. You're not putting all your eggs in one basket. You're taking a portion of your capital, and you're investing in a new venture, but you're still a real estate investor. You've diversified. The point of this is not to get you to follow the exact path to $1 billion. The point is to show you the principles. The mindset, the way the ultra-wealthy think about money. It's not about saving, it's about leveraging. It's not about slow growth, it's about strategic pivots. It's not about avoiding risk, it's about managing and mitigating risk to get outsized returns. Let's address the fear of failure head-on. The fear of failure is the number one thing that keeps 99% of people from ever attempting something great. It's the reason most people stay on the traditional path. They are so afraid of losing their $20,000 that they never give it a chance to become $200,000. But the ultra-wealthy understand something fundamental. Failure is the best teacher, and a well-designed system can absorb failure. My own philosophy is simple. If you're not failing, you're not innovating enough. But that doesn't mean you're being reckless. It means you've created a system with built-in redundancies and safety valves. The 4-year blueprint I've laid out is exactly that. Consider the real estate phase. What is the worst-case scenario? Let's say you buy a distressed property, and a market crash happens right as you're finishing the renovation. Your after-repair value, instead of being $250,000, is now only $200,000. That's a massive hit to your initial plan, a failure by the standards we set. But you still own a tangible asset. You've still created value. You can rent out the property for a positive cash flow. Your loans are still being paid. You have not lost everything. You've simply had to pivot to a longer-term strategy, a buy-and-hold strategy, which is still a proven path to wealth, just a slower one. The system did not collapse. It adapted. And while you wait for the market to recover, you can use the skills you learned to find another deal, perhaps in a different, more stable market. The skills you gained from that first flip are your ultimate safety net. The ability to source deals, to negotiate, to manage a project, to understand financing. These are skills no market crash can ever take away from you. You are now a competent, proven operator. You are no longer the person who had $20,000. You are the person who knows how to turn $20,000 into a wealth-generating asset, and that knowledge is far more valuable than the initial capital itself. Now, let's look at the tech pivot. This is undeniably the riskiest part of the plan. A significant portion of startups fail. That is a known risk. But again, this risk is managed. You did not put your entire net worth into this single venture. You invested a portion of the millions you earned from real estate. You still own a portfolio of cash-flowing real estate assets. Your millions didn't vanish. A portion of them was deployed into a high-risk, high-reward bet. If the startup fails, it is not a catastrophic failure. It's a learning experience. You lose a portion of your capital, but you have the rest of your assets and a new set of invaluable skills, evaluating business models, spotting talent, and understanding the digital economy. The point is that the real estate business you built is your foundation. It's the stable base from which you launch your rockets. You have the luxury of taking calculated risks because you have a solid, cash-generating system below you to catch you if you fall. Most people try to launch their rockets from the ground, with no safety net, and a single failure means they are back at zero. But this plan is designed to make sure that a failure in one area doesn't wipe you out. It simply forces you to learn, to adapt, and to launch again. This is the hidden key to why the ultra-wealthy take more risks. It's not because they are inherently less afraid of failure, it's because their failures are cushioned by a robust financial system they've built. They don't risk their ability to live or their baseline of wealth. They risk a small portion of their capital for a massive, outsized return. So, when you think about this plan, stop thinking about what could go wrong. Start thinking about the principles that make it so resilient. Think about the power of leveraging capital you don't have to acquire assets. Think about the power of adding value to a tangible asset to create equity from nothing. Think about the power of building a system that can run without your constant presence. And think about the power of using the wealth from a physical business to fund a digital business with unlimited scale. This is the mindset of a builder, a creator, and an innovator. And it is the only way to play the game on a level where billions are the prize. Okay, let's talk about the part that nobody talks about. The mindset. This journey isn't just about spreadsheets and market analysis. It's about you, the person who is going to execute this plan. Going from $20,000 to $1 million and then to $1 billion requires a level of mental fortitude that most people simply don't have. You will face failure. You will face setbacks. The renovation will cost more than you thought. The tech company will have a catastrophic bug. You'll lose money, but the person who succeeds on this path doesn't see failure as an end. They see it as data. A lesson, a cost of doing business. You have to develop an ironclad belief in yourself and in the principles you are applying. You have to be obsessed with learning, with reading, with networking. You have to be a hunter of opportunities. You must become financially literate in a way that goes beyond the basics. You must understand taxes, legal structures, and how to build a team. This is not a lone wolf journey. You must be able to attract and retain the smartest people in the world. This is the psychological tax of being a high-level wealth creator. The money is just a byproduct of the person you have to become. Let's get real for a moment. The 4-year blueprint I've laid out is a logical, rational, and repeatable process. But the world is not a clean spreadsheet. It is messy, unpredictable, and often hostile to grand plans. The blueprint is the map. Your mindset is the compass, and without a well-calibrated compass, the map is useless. The truth is, this journey is not for the faint of heart. It requires a level of obsession that most people will find unsettling. You won't be able to turn your brain off at 5 p.m. Your mind will constantly be hunting for deals, for problems to solve, for opportunities to leverage. This isn't work, it's a mission. It's a deep-seated drive that comes from a place far beyond just wanting a bigger house or a nicer car. It comes from a need to create, to build, and to solve. The money is a scoreboard, a metric of your success in that mission. Let's talk about the most common obstacle you will face: doubt. The world will be full of people telling you that this is impossible. Your friends, your family, the so-called experts. They will tell you to be realistic, to play it safe, to take the traditional path. The traditional path is safe because it is mediocrity. To achieve something extraordinary, you must be willing to be an outlier. You must develop a profound, almost spiritual belief in your own ability to execute, even when the evidence is stacked against you. You must become comfortable with the feeling of being misunderstood. This journey is also a crash course in managing failure. You will make mistakes. Your first deal might not be as profitable as you hoped. You might spend too much on a renovation. A key hire might not work out. Most people would see these as reasons to quit. The person on the exponential path sees them as data points. A failure is simply a piece of information that helps you refine your process for the next attempt. We learn more from our failures than our successes. Every mistake you make is a lesson in resilience, a training exercise for your mental fortitude. The goal is not to avoid failure. The goal is to fail cheaply and fail quickly, and then to learn the lesson and integrate it into your system. Furthermore, this path forces you to become a student of the world. You have to read, constantly. Not just about finance, but about technology, history, human psychology, and systems. You have to become a collector of mental models. You must be able to see patterns where others see chaos. You have to be able to connect the dots. The most powerful ideas are often found at the intersection of seemingly unrelated fields. And finally, you must confront the myth of the lone wolf. The lone wolf dies alone. The most successful people in the world are not solo heroes, they are brilliant orchestrators of talent. Your ability to get to $1 billion is directly proportional to your ability to attract, inspire, and retain other smart people. You need to become the kind of person that others want to work with. You need to be able to sell a vision, to delegate a task, and to trust in the abilities of others. You are no longer just an investor, you are a leader. This is perhaps the most difficult skill to master, but it is the one that unlocks true, unimaginable scale. The money, the billions, are not the point. They are the metric of a life lived with purpose. A life spent creating, building, and solving problems on an increasingly grand scale. The 4-year journey from $20,000 to $1 billion is not just a financial plan, it is a crucible for personal transformation. The money is the reward for becoming the person who is capable of doing it. The true prize is not the $1 billion in your account. It is the mind and spirit you forged in the pursuit of it. This is the ultimate, non-negotiable part of the plan. Alright, you've seen the plan. But what do you do today? You probably don't have $20,000 sitting around. That's okay. The first step isn't about the money, it's about the mindset. Step 1. Get to $20,000. This is your first hurdle. If you're starting from scratch, you need to be obsessed with accumulating that initial capital. This means side hustles, cutting expenses, getting a higher paying job, anything it takes. This is your seed capital, the key to the entire operation. Step 2. Become a financial detective. Your mission is to find the right, undervalued asset. This means spending hours on Zillow, Redfin, and local real estate forums. Start identifying distressed properties in your area. Look for the ugly house in the nice neighborhood. Find the deals that nobody else is looking at. Step 3. Build your network. Start connecting with other entrepreneurs, real estate investors, and local lenders. You can't do this alone. Your network is your net worth. Go to local meetups, join online communities, and start asking smart questions. This isn't a passive journey. It's a mission. The person who will succeed is the one who will act on this information, not just watch it. Let's be clear. This entire blueprint is an intellectual exercise until you take action. The most powerful principle in the universe is not leverage, it is execution. It is the bridge between a great idea and a tangible result. Everything I've told you is useless if you don't start today. Not tomorrow, not next week, today. So let's break down these 3 initial steps. This is your training montage. This is where you build the muscle, develop the discipline, and forge the habits that will carry you through the entire journey. Step 1. The race to $20,000. This is a personal challenge. It's a test of your resolve. Most people would look at a $20,000 goal and find it insurmountable. You must see it as the first, most critical milestone. This is where you embrace radical frugality. You cut out every unnecessary expense. Your daily latte, your subscription services, your impulse buys, all of it is a tax on your future. Every dollar you don't spend is a dollar you've earned. But frugality alone won't get you there fast enough. You need to increase your income. This means taking on side hustles. Not the kind of side hustle you do for fun, the kind you do to make money. Driving for a rideshare service, delivering food, freelancing, tutoring, selling items online, whatever you can do in your spare time to earn an extra dollar. You should be so obsessed with this first milestone that your spare time is non-existent. You are a human money-making machine, and your only mission is to get to that $20,000 mark. You will feel a shift in your identity. You are no longer a consumer, you are a capital accumulator. You are a collector of resources. Every dollar you save or earn is a step closer to the starting line. Step 2. Becoming the financial detective. The world is full of opportunities, but they are often hidden in plain sight. You must develop the eyes to see them. This means you are no longer just browsing Zillow for a dream home. You are a data analyst. You are a detective. You are looking for patterns of distress. Overgrown lawns, peeling paint, notices on the door, uncollected mail. These are not signs of a bad neighborhood. They are clues that a property owner is in distress and may be willing to sell for a discount. You need to go beyond the typical online searches. You need to drive around neighborhoods that have good fundamentals, good schools, low crime rates, proximity to jobs, but contain a few neglected properties. You need to look up county records for pre-foreclosures, tax liens, and probate sales. This is the work that most people are unwilling to do. This is the grunt work that leads to the massive returns. You are building a list of targets. You are scouting the battlefield before you engage. And with every property you analyze, you are building a deeper understanding of what makes a good deal. You are learning to run the numbers in your head. You are training your intuition. Step 3. Building your army. This is not a solo mission. The lone wolf myth is for the movies. In reality, every successful person has a team. Your first task is to build a network of people who can help you. You need to find a good real estate agent who understands investors, not just home buyers. You need to find a reliable contractor with a good reputation. You need to find a private or hard money lender who can get you the capital you need. Where do you find these people? You go to them. You go to real estate investment clubs. You join online forums and professional networks. You go to local meetups. When you're there, you don't just talk about yourself. You ask smart, insightful questions. You offer to help others. You provide value. You show that you are serious and that you are an operator who is ready to execute. Your network will be the source of your best deals, your best financing, and your best advice. Your network will be the collective brain and resources you can leverage to solve problems that would be impossible for you to solve alone. This is your mission. These are your first 3 steps. There is no magic pill. There is no secret. There is only a simple, repeatable process that starts with action. The person who gets to $1 billion is not the one who waits for the perfect opportunity. It's the one who starts today, with what they have, and relentlessly builds their way up, one step at a time. Your journey to $1 billion starts right now. The world of money isn't a secret society. It's a game with rules. Most people play the game on the lowest level, saving and budgeting. They're playing checkers. The ultra-wealthy are playing chess, with every move calculated for maximum leverage. The journey from $20,000 to $1 billion isn't about luck. It's about a blueprint, the one you just saw. It's about the audacity to believe that exponential growth is possible. It's about the willingness to learn, to fail, and to get back up. This is the kind of thinking that separates the masses from the masters. This is Get Rich Academy. We don't teach you how to save. We teach you how to get rich. If you're ready to start playing the game on a higher level, subscribe to the channel right now. Don't let this be just another video you watched. Let this be the video that changed your mindset forever. The next step is in your hands. I've laid out a roadmap. I've shown you the principles, the mindset, and the actionable steps. This is the end of the broadcast, but it is the beginning of your journey. The most important thing I can tell you now is that the only way to fail is to do nothing. You have a choice to make, right now. You can continue to live by the old rules, the linear path of trading your time for money, of hoping for the best, and of letting your fear of loss dictate your actions. Or you can start playing by the new rules. The rules of leverage, of strategic pivots, and of managed risk for outsized returns. The blueprint is simple, but the execution is hard. It will test your resolve, challenge your beliefs, and push you far beyond your comfort zone. You will face resistance from the people around you, from the systems in place, and from the voice inside your own head. But every time you overcome a challenge, you are not just getting richer, you are becoming stronger. You are becoming a more competent, more resilient, and more confident version of yourself. This is not a get-rich-quick scheme. This is a get-rich-slowly and then get-rich exponentially blueprint. The first few years are about building the foundation, about proving the model, and about earning the right to play in the big leagues. It's about earning your seat at the table with the venture capitalists, the big real estate players, and the other entrepreneurs who are building the future. Your journey will be unique, but the principles will remain the same. The principles of leverage, of turning a small amount of capital into a commanding position over a large asset. The principle of value creation, of adding something to the world that wasn't there before and reaping the rewards. The principle of the strategic pivot, of knowing when to change course and to abandon a limited system for one with limitless potential. Remember, the goal is not just the money. The goal is the freedom that money provides. The freedom to pursue your passions, to solve the problems you care about, and to build a life on your own terms. The money is just the tool that makes all of that possible. So, don't let this be just another video. Let it be the catalyst. Let it be the moment you said, enough is enough. I'm going to change the way I think about money and the world. Start today. Start with the race to $20,000. Start with becoming a financial detective. Start with building your network. Start with the first step of a journey that could change your life forever. Thank you for watching. The next step is in your hands. Your journey starts now.